The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
And now, it's time for Radio Jobline with your host, Scott Possessor, right here on 103.9 LI News Radio.
Welcome, everybody. It must be Saturday afternoon from 2 to 3 p.m., or it might be Wednesday night from 9 to 10 p.m. We're on twice a week to talk about your career, look at the job markets, look at the talent pools, look at the economy. We look at everything that could affect the success in the workplace of any human being on this planet, but we do focus, of course, on the Long Island area, which is where we're based. I have a fantastic guest, one of my regulars here on Radio Jobline today, and we're going to talk about the economy. And before I introduce him, I just want to talk about my haircut. All right? Now you have to pay attention to this, folks. You know how you go through life, and most of your haircuts are consistent, right? You get a consistent haircut. I got a haircut so bad, it was shorter on one side than the other. It's sticking up because it's so short that it's actually sticking up in the air, and I can't use product to get it down. So I look like Reggie from the Archie comics, okay? And it's been that way for a couple of weeks. Plus, she shaved off one side, but not the other. So I've never seen anything like this. This was the haircut of a lifetime. It's taken me 2 weeks to get over it, emotionally, physically, and by appearance wise. I'm just getting back on track from it. We're joined by Michael Hartzman today. Michael is a certified financial planner, a good friend. He has been on Radio Jobline at least 4 or 5 times over the last year and a half, constantly keeping us updated on the economy. And before I even introduce Mike, I just want to whine and complain for a bit. I'm still hearing 2 schools of thought. One school says everything's fine. Everything's fine. The stock market is up. We're on the verge of getting interest rates. The soft landing is here. You couldn't have a thing to complain about. The economy is strong. We don't have any negative GDP growth. We got all the things that are great. Then you see people like Jamie Dimon and many others who are saying, as recently as yesterday, flashing lights are going on, that we're finally hitting the recession. So I get angry and upset by this because 4 years, Michael, this is our 4th year talking about a recession, okay? And there's still no agreement. There's no unity. Everybody's sensitive to whatever Jerome Powell says, which I guess they should be. And so it just seems like it's still a train wreck, although it might be getting a little better. So just give me some initial thoughts, and then I'll read your bio.
Hey, Scott, how are you? Your hair looks great, by the way.
Thanks. I'll give you that $5.
And we are on the radio, so no one really cares anyhow.
I know. I thought they'd get a kick out of it, though.
It's a good story. Look, I think, as I've said on previous shows, that both schools of thought are partially right. Mm-hmm. And I think the school of thought that things are more good than bad is more right than things are not good. The one thing I will tell you is that inflation has stayed very, very sticky. Mm-hmm. And that is where most experts, most economists, quite frankly, have been wrong. Mm-hmm. So as we speak right now on this show, the Fed is speaking as well. Jerome Powell is doing his press conference. The Federal Reserve just ended their 2-day June meeting, and as expected, they did not raise interest rates. Mm-hmm. What they did say was they will probably lower interest rates one time this year. Mm-hmm. So the thing that's been frustrating, the thing that frustrates you, the thing that frustrates Jamie Dimon, I think, and many other experts and as plain old people who feel the effects of inflation, is we are not getting the 5 or 6 interest rate cuts that we went into 2024 expecting. Mm-hmm. Now, I always felt, and I said on this show, that 5 or 6 interest rate cuts were not reasonable. I never thought that would be an expectation. I thought 3 was a fair expectation. a couple of meetings my partner and I went to earlier this year, that was down to 2. Now we're down to 1. And quite frankly, we may get none. And we could explain why in a little bit. But I wouldn't even hang my hat on one interest rate cut at this point.
Okay. Which all leads me back to how I started this show, in that nobody knows what's going on. This is the disturbing piece. Despite your superior brain, Mike, and everything that you're doing, you still can't be sure one way or the other after all this time. Now, when I call him a superior brain, let me read about Michael Hartzman. He's a certified financial planner, a Wall Street veteran who specializes in retirement planning, education, elder and estate planning, life insurance, and long-term care. His vast knowledge of these subjects are discussed weekly on his podcast, which I have been on. It's wonderful. The Lebenthal Report, a business show that keeps investors informed about the current market conditions, opportunities, and risks in the financial markets. As co-host, Michael helps guide listeners through the complex world of investing while breaking down today's headlines and stories into easily understood concepts, providing the kind of sound fiduciary advice his clients have received for years. Michael's currently partner and president of Lebenthal Financial Services, Inc., a full-service independent broker-dealer with an emphasis on financial and retirement planning, as well as president of Bristol Capital Corp., a full-service insurance agency specializing in life insurance, long-term care, fixed annuities, and employee benefits. He's written various articles on retirement, estate planning, as well as the state of the market in publications such as 50-Plus, Lifestyles, and The Legal Brief. Welcome, Michael, to Radio Jobline. And thank you for keeping us informed.
You're welcome.
Because you can't do a show about success in the job market unless you keep an eye on the economy. The economy is one of these things that you have to look at and say, you know what, the economy is not doing well in that area. Construction is slowing down. Well, I better not look for a job there. Life sciences stopped hiring 2 years ago. Better not look for a job there. So it's all about the economy. If we didn't have you or economic knowledge, all job hunters would be confused about where to go and how to go there.
Absolutely. But at the end of the day, a person picks a career and they hope they're in that career for a long time, and they hope the economy sustains that career. Right now, the overall job market has been overperforming what the expectations were. And what I mean by that, yes, the job market is weakening. You and I shared a video that came out 2 days ago about the JOLTS report, which you're more of an expert about that than I am. You live and breathe the job market. But the truth is, with the economy, with inflation being as stubborn as it has been, and interest rates staying as high as they have been for as long as they have been, the one of the silver linings has been the job market has been resilient. Now, you're right, sector by sector, things are obviously weak in pockets of the country in different sectors. But overall, Scott, the job market has just not fallen apart.
Yeah, amazing. And I feel like I'm right in the trenches and I see it, from the inside out. I'm a little worried about the real estate market, and I'll tell you what I read about that recently. I could be reading one of these perverse, wrong people, that's putting out bad information, but they're saying that the real estate boom is going to stop. Your house is going to be worth less next year because interest rates have remained high for so long, for whatever reasons, Mike. Is there any truth to this? They went up. The cost of homes in Nassau County and Suffolk County has risen between 12 and 15% in 1 year, just this last year. So is that sustainable?
No, I don't think that's sustainable, but I also don't think that we're going to come into a part of the economy of complete deterioration, because don't forget, when interest rates come down, it creates two scenarios. Someone who's a little older who wants to sell their home will say, okay, now's the time to act. Maybe I could raise the price of my home a little bit because interest rates are lower. Younger people could borrow money at a lower cost. And younger people who want to stay on Long Island, want to start a family, sometimes, Scott, they just got to jump in and they can't time it perfectly. So Yeah, I have a lot of clients who are realtors, and they tell me that they basically have a bidding war on homes, and they can't keep the inventory out there for very, very long. But part of that, Scott, are mine and your fault, because 5 or 6 years ago, we took advantage of these super low interest rates. We refinanced our mortgages at 2 or 3%. And we're not going anywhere. So that also impacts the inventory. But in terms of the overall real estate market deteriorating, especially on Long Island, I don't see that happening, but obviously you could see it cooling off.
Yeah, so maybe instead of 12%, it'll be 6% or something like that. But it's still going to go up.
I think so. As someone once told me a very long time ago, God's not making more real estate.
Right. And real estate's still one of the safest bets of all of them. You know, the stock market, of course, over time is great. But what about real estate? I mean, look at what my house. My house is probably increased by $250,000 in value since I bought it 12 years ago.
Which is phenomenal. Probably the best investment you ever made.
And it was an accident to it. I'll tell you all about it. Anyway, I wanted to get that real estate piece out. I wanted to talk about the different pockets that are not doing well of the economy, the various sectors which we've already sort of addressed. You know that there's always going to be, you know, a couple of sectors. Like construction is doing well, actually. Restoration. An industry I think I introduced you to. It was a cottage industry. Now it's a multi-billion-dollar business all over the country. You can't drive down 347 without seeing restoration trucks. Where were they 5 years ago? I mean, there was no such industry. One of the fastest growing things I ever saw. We can't make enough placements from the executive search perspective in the restoration business. But, you know, other things that we thought would be great, like life sciences, have not turned into the big hiring monsters that we thought they were. They were for a while, from right up until 2021. That was one of the best job markets out there. That has changed. So I'm giving you the bird's eye view from inside, you know, from what we're seeing, you know, the finance, not the same kind of hiring that was going on even 5 years ago. You know, it's significantly different.
Well, you mentioned two sectors which are very sensitive to interest rates. And the reason the life science sector is sensitive to interest rates is they're typically, and you tell me if I'm wrong, they're typically smaller companies. They're typically non-publicly traded companies. They typically do a lot of research and development. And that typically requires a lot of money. So when interest rates are cheap, money is cheap. They could borrow money at lower borrowing costs. When money becomes more expensive, the banks tighten up. They do a little bit more due diligence on these companies, and the money may not be flowing as freely. So, you know, you mentioned 2021 was a good year for them. Things got cold in 2022. Guess what? That's exactly when interest rates started to go up.
Yeah.
So there is definitely a correlation between that industry and also the same thing in the banking industry. When interest rates go up, money becomes more expensive, and there's not as many loans written. Yeah. And the requirements become more stringent. So there's definitely a correlation, and not to sound like a broken record, but interest rates has been the theme all year long of this entire economy. It all traces back to that.
Yeah. So now we're pushing our hope that interest rates come down with some significance. Perhaps you said one rate cut this year, perhaps, but maybe more like several rate cuts in 2025. You know what that reminds me of, Mike?
2024?
2023. We said the same thing. We said, you know, the rates are high enough. We're going to stop raising them. Then we're going to have an improvement of recessionary economics, and we're going to start lowering the interest rates. Well, the interest rates aren't going down until 2025. What's to say we get into the first quarter of 2025 and all of a sudden people will go, well, you know what? They're not going to come down until 2026. Is that possible?
Anything's possible.
Yeah.
I mean, my partner and I have been very fortunate to be in a room with some really well-known economists and well-recognized people who you see on TV, and we get to see their unvarnished comments. And one person in particular basically said, we don't know what we're talking about. That the economists and the sector has basically been completely wrong by predicting 5 or 6 interest rate cuts in 2024. And that's not to say these are not really bright people. What it basically indicates is that the economy has been really, really resilient. And let me repeat that. The reason interest rates are not going down is because the economy is stronger than anyone expected. And I think when, the way you opened your show, that's kind of the dichotomy that people can't get their brains around. They're so hyper fixated on why are interest rates going lower that when I tell them, well, it's because the economy's too strong, that's where I see sparks flying, like I'm out of my mind. But just think about it logically. If the economy is staying stronger than the Federal Reserve wanted it to or expected it to, then what's the impetus for them to lower interest rates?
Yeah. I found myself rooting against myself. Now, remember, 2 months ago, the jobs created were in the 100s, 130,000, something like that, jobs created. And I thought, finally, the Fed's getting what it wants. It choked off the economy enough so that the job market is finally not doing well. And now they're going to lower interest rates. So what happens this month? We come roaring back with 250,000 or so jobs created. So, that's not what anybody was expecting.
Right. But it's not a bad thing.
But how can they be so wrong about that?
That is the $1 million question, right? How could they be so wrong about that?
I mean, just 1 month. Say, okay, we're expecting the interest rate, the job creation to be 180,000, and sure enough, it's 270,000. How could they be wrong? I'm just so disturbed by the lack of precision in this business that you're in. Right. I know a lot of it is conjecture and opinion and hope and feelings and interest watching and stock watching, but it just seems it's so imprecise it could drive a person crazy.
Well, economists are like the weathermen, right? They get paid to be frequently wrong.
Right.
And I'm not an economist. I'm a financial advisor, and my job is to not get caught up in the day-to-day minutia. And my job is to make sure people are properly asset allocated. But you're not wrong. My partner Dominic and I have been fighting this narrative all year long because, as I said, if you go back to listen to our podcast in January and February, we felt 5 interest rate cuts was unreasonable. Now, I didn't think it would get down to 1 or possibly 0, but it really boils down to, and I know this is a topic near and dear to your heart, inflation has remained sticky. And that is the true pain to the consumer.
What's the rationale there? Why is inflation not improving at a slightly better rate than it is now?
Well, it's improving. It was improving dramatically, and then it got stalled. So right now it's stalled at around, I think, 3.3%. And again, the reason that is the case is because, you and I sitting in an airport right now. It happens to be, not a well-trafficked airport.
Right.
But last week I was in Kennedy Airport, and it's mobbed, and the flights are mobbed, and the restaurants are mobbed, and people are still out there, Scott, and they're still out there spending money. So because the economy has stayed resilient, it really has not caused a price decrease. And we talked about that in the wintertime, when there's going to be a little deflation. I know that's something that, you are really concerned about, and there isn't any. There is very little price decreases going on in the supermarket or any place else. So I think that's the problem, that the economy overall has stayed very resilient. And the reason, again, is because of the job market. Because if people feel comfortable and confident that they're not going to lose their job, they're going to continue to live their life. The moment they have job insecurity is when they shut that pocketbook.
So that hasn't happened.
That has not happened.
Thank goodness, it hasn't happened. But then again, there's always part of me that says, why can't we just get this recession over with? Why can't we let it hit bad job creation numbers. Let everything happen that's supposed to happen on the bad side so that they can finally start dropping the interest rates. That'll rebuild consumer confidence, and then we're on our way to a recovery.
So I know your hair is standing up.
Yeah.
So I'm going to say something. It's really going to be standing up. We're not going to have a recession.
Right.
We're not going to have one.
All right.
It's unless the economy just hits a brick wall, or there is some unexpected black swan that we don't know about, like a pandemic or a war, where I don't think, again, as you said, how do we know for sure? I think we've avoided a recession. As frustrated as you might be with Jerome Powell and the Federal Reserve and the United States government, we avoided a recession.
I'm just frustrated by the length of time it has taken for us to keep discussing this topic. I would like for something to have happened that's more definitive over the last 40 months. Something that's, okay, we're heading down, we're heading up. Well, instead it's we're up, we're down, we're up, we're down.
Okay, can I give that some context?
Wait, not yet.
Okay,
not yet. We got a few seconds. You're listening to Radio Jobline with Scott Possessor. I have the fabulous Michael Hartzman, a certified financial planner from Leventhal, with us today. He's giving us an opinion. He's trying to calm me down because I get very excitable about the economy. If you would like to be a guest on Radio Jobline, you can write to me, scottp118@gmail.com. scottp118@gmail.com. I'll be happy to have you or your idea on the show. We have an entire section coming up with Michael Hartzman to talk about many more things, economic and such. I also want you to connect with me on LinkedIn, Scott Possessor, P-A-S-S-E-S-C-R. We post all of our shows on LinkedIn. Be right back.
And now, welcome back to Radio Jobline with your host, Scott Possessor, right here on LI News Radio.
Welcome back to Radio Jobline with Scott Possessor. I am joined today by my friend, Michael Hartzman, a certified financial planner. Michael he's one of the 5 cornerstone guests that comes on Radio Jobline regularly to keep me from losing my mind. I think Michael even does a fabulous job, not only in his job, but he's great on the radio and has a great bedside manner. And Mike, you make me feel more calm. When you leave my shows, I feel like I've fleshed out some things and got some bad blood out of my system.
Good. I'm glad I could help.
Let's talk about the stock market, which just keeps going up. I mean, again, you could go nuts watching this.
Yeah. So, you mentioned right before the break, let's get the bad stuff out of the way and let's get some consistency. And I would argue that that's been going on for about 18 months now. So 2022 was really a bad year. You can't sugarcoat it. The S&P was down about 22%, the S&P 500. The NASDAQ, which is mostly tech-heavy companies, was down about 30%. By anyone's calculation, those are really, really, really bad years. 2023, the S&P 500 was up 24%. The NASDAQ was up around 30%. So far this year, the S&P is up 13% through Friday, June 7th, and the NASDAQ is up 14.5%. Same date.
So trending the same way.
Two great back-to-back years, and I would argue, because I have this conversation all the time with my own clients, it's kind of been a stealth bull market where people just don't believe it, and depending on the news bubble that they travel in, they never really hear about it. But the stock market, and I will admit that last year the gains in the stock market, Scott, were driven by the 7 companies that got to be known as the Magnificent Seven. And that did skew the returns, because there was a point last year, although the market was up significantly, 493 companies were meh, and these 7 companies were going through the roof, right? But at the end of the year, from October on, the market has basically done what we call widened out, and all those other companies are still doing well. A lot of other companies now are participating in this rally. So there's always pockets that do well. There's always pockets that do, but the stock market overall if you simply own the index, you're not an unhappy camper over the last 18 months.
Right. And this is all in part because it seems to me they're cheerleaders, right? So they're on the sidelines and they're going, well, let's see the job market. Oh, that stayed good. Let's bring the market up, or no, the job market was too strong. Let's bring the market down, because you're not going to get your interest rate cuts. So there's a huge sensitivity to what happens with the rest of the economy as it relates to the market.
It does, but the other factor is earnings. Right. So at the end of the day, people invest money in companies that they feel have sustained long-term growth potential. So it's not necessarily only the job market or interest rates. It's all these companies performing. Are they making money? Are they adding value to their shareholders?
Let's talk about that.
Okay.
So NVIDIA.
All right. You just picked, at the moment, the most popular stock in the market, right? NVIDIA is up an insane amount of money in the last several years. And because they're smack dab in the middle of the artificial intelligence boom, but that's a company that has had outrageous growth, unbelievable growth, but the market feels it's justified because they continue to make money and they continue to add value to their shareholders. So it's not based on wishes and hope. They are actually making money.
Okay. And tell me about the split.
So NVIDIA was trading around $1,000 a share last week.
Wow.
A little over $1,000 a share. 2 weeks prior, they announced a 1-for-10 stock split. So if you owned 10 shares of NVIDIA 2 weeks ago, today you own 100 shares of NVIDIA. Now, what gives people minor coronaries is if you don't keep track of the news and you see that the stock is trading at $1,000 and you go on your phone and just check the price of your stock and now it's 100, you have that oh crap moment. But that $100 now is reflective on you owning 10 times more shares.
Right.
And the reason a company does that is severalfold. One, they want to make the stock more attractive to portfolio managers, to mutual funds. Mutual fund companies typically don't like to buy $1,000 stocks. That's why several years ago, Amazon split and Apple split. And the other thing they do is they create more liquidity because, again, if they did a 1-for-10 stock split, now that means there are 10 times more shares on the market for investors to buy. So it also gives the opportunity, like I had a client today who wanted to buy 55 shares of NVIDIA. If they would have made that purchase 2 weeks ago without the stock split, they would have bought 4. So just psychologically, an investor feels better not buying 4 shares. So that's what happened.
Well, sometimes you hear things. I remember I used to have a good friend that worked for a fund management company. And I remember specifically, this was way back, I think in the 90s. And Apple stock was selling for $17 a share. And if I look back and I say, what if I would have just bought 100 shares? Just 100 shares at $17 a share would have been $1,700, whatever. And what would that be worth today? I mean, so the mistakes you make, and people are really experts at picking stocks and so on, but you can't get it all right all the time. No, you can. And the chances of anyone buying an Apple and still holding on to it, that's like catching lightning in a bottle. So you can't really beat yourself up over that. And you also have to remember that, yes, Apple at that time was a great stock and Apple hit the skids for a number of years. And then Steve Jobs came along and he invented this little thing called the iPod and he basically changed the music industry. And then right after the iPod was the iPhone. So yes, you would have done very, very well with that $1,700 investment, but you can't beat yourself up over it because, as I said, you don't even know if you would have held on to it this entire time. But don't do the math. You don't want to know what it would have been worth. Right. Now, I'm afraid to ask, but you could do it. If you had a ballpark it, 100 shares at $17 a share in 1985. I don't know, $500,000. $500,000.
I mean, but I would have to do the math. I don't know off the top of my head.
It just makes me sick that that I was sitting right next to the guy that did this buys. Yeah. And he could have bought it for me, and I put it in.
It's just a guess. If the regulators are listening, it's just a guess.
Just a guess. Okay. All right. So the market keeps going up. We've sort of explained, what's going on with that. Tell us a little bit more about what happened in that meeting on Wednesday.
So the Federal Reserve had their June meeting, which usually is a day and a half, all day Tuesday, half day Wednesday. At 2:00, they make the announcement. The announcement was that they were holding interest rates steady, which was expected. Mm-hmm. If they would have raised interest rates today, the stock market would have tumbled. Mm-hmm. There's no doubt about it. Mm-hmm. So they kept interest rates steady. The market didn't react to that because that's what the market expected. They got what they expected. The expectation was going into this meeting that the Federal Reserve will lower interest rates twice this year. Now, before the meeting, we were down to 2.
Right.
One in September and one after the election. We're now down to 1. Now, the Federal Reserve, Jerome Powell, said that inflation has stayed a little more stubborn than they anticipated. So they're not ready to lower interest rates yet. The target CPI, Consumer Price Index, that the Fed is shooting for is 2%. Mm-hmm. As I said earlier, the CPI is hovering around 3.3. Mm-hmm. So it's going to take a while to get that extra 1.3%. Mm-hmm. And the Fed is really, really reluctant to lower interest rates too soon. But so we're down to 1. The market reacted, okay to an initial reaction. I think it'll be more proof to see what happens over the next couple of days as it relates to that. But, and they said maybe 4 interest rate cuts next year. Mm-hmm. But again, maybe.
Okay. So people like me are now jaded. So when you say that, it's like, I'm not going to do anything about that. If it happens, it happens. What I do want to talk about is the companies themselves. Other than the Magnificent Seven, are companies making money? Is there some chance that we're going to get some price cuts? What's happening with the companies at large in America?
The earnings on a quarter-to-quarter basis have not been terrible. They've been good. They've been quite good. More than half the companies are profitable, and more than half the companies are raising their earnings outlook. So yes, things are slowing down. Things are deteriorating a little bit, but not enough for us to have a recession, and not enough to see large companies falling into the red.
All right. One thing that's really going to cause some major turmoil is the upcoming election.
Really?
Yeah. I think it's probably going to be one of the deadliest of all time. And when I say that, have the most repercussions of all time. You can't take a side in this country anymore, Michael. If you're a Democrat, you're hated by Republicans, and if you're a Republican, you're hated by Democrats. I don't remember it really being like that, honestly, before the last 7 or 8 years. But the bottom line is it's true. There's hatred now. There's you're an idiot. The other side is an idiot. And it's just gotten so divisive and so ugly. But I think people are beginning to wonder about the impact on the economy. How do you see it going if the Republican side wins or the Democratic side wins?
The stock market doesn't care.
The stock market doesn't care. Okay.
So typically, whether it's a Democrat in office or a Republican in office, the statistic that I heard is over a 4-year administration, Republican administrations do better than Democratic administrations by just 1 percentage point. Mm. Right now, what the stock market hates, any stock market hates, is uncertainty. Mm-hmm. Stock market knows that these are the 2 candidates, right? Stock market knows what the Democratic agenda is, what the Republican agenda is, and the stock market will adjust on the fly. Mm-hmm. The problem is, and you are 100% correct, it's people care. Mm-hmm. So it's the job of a financial advisor like myself to keep people in their lane. When I get a phone call where they say to me, and I'm already getting the calls, well, if it appears so-and-so is going to win, you got to sell me out. or if it appears so-and-so is going to win or lose, get rid of everything. And look, at the end of the day, if I can't talk
Mike, what's powering that? What's powering those calls?
Well, it is the media it's fear and agita, that sells, it gets eyeballs on TV. And I'll give you a perfect example. 2 months ago, the inflation number came out, and that's when it was a little hotter than expected. And I went to one news cycle, one website, and it just very matter-of-factly said that inflation was a little higher than expected by 0.2 percentage point. Okay. I went to another website, and it showed a picture of a wallet on fire. And the headline was, inflation continues to go up. So if you see a wallet on fire, what are you expecting to believe, right?
Bad news.
Bad news. So to me, it's how the media, whatever bubble you traffic in, is what you're going to want to make your investment decisions about. And it's a job of a financial consultant to basically, talk people into being a little bit more reasonable, a little bit more moderate, and not trying to make those rash decisions.
So are you able to say at this point then what might happen? So are you? Is there a scenario for both? So if the Democrats get in, then could happen, and if the Republicans get in, this could happen. Is there anything like that that's being talked about in the inner circles?
No. Well, again, Scott, you have to remember that it's not just the president. Is it the
House, the Senate? Is
it a split government? Because if it's a split government, then it's going to be business as usual. But if the Republicans sweep everything or the Democrats sweep everything, which is unexpected, then yes, maybe if you're a wealthy individual, you worry about higher taxes. If the Democrats get in, so that's always a possibility. But in terms of long-term investing, I would argue that none of that matters. In the short term, there's always going to be pockets of volatility, but the stock market, as I said, knows these are the two candidates and will adjust on the fly as to whichever one gets in. And Scott, really think about it. Look at 2016, where the quote unquote experts then, these were pollsters, not economists, thought Hillary was winning. And then Trump won. And then overnight, the stock market futures were down 1,000 points. And by the time the stock market opened, it was a party, right? They adjusted to the fact that Trump actually won the election. And, here we are. And here we are now, some people, again, whoever they pick, it is what it is. Biden, this is his fourth year, right? He's had 3 really good years and 1 really bad year. So even with a Democrat in office, the stock market has not been bad at all, except for 2022.
I wonder if we could actually trace back the avoidance of the recession to Biden's administration. Did they do something right, Michael? Because, it's never one man. It's never one man. It's always a team. It's always a party. But, could we say that Biden's administration is responsible for avoiding this recession, through the words and actions of Jerome Powell?
Yeah, well, look, I think Jerome Powell probably deserves most of the credit. He got heavily criticized, deservedly so, in the beginning of 2022 because he was too slow in raising interest rates, stopping inflation. He's too slow in putting his foot on the brake of the economy. But since then, he somehow has guided the economy, with a lot of finesse to avoid a recession up until now. So, but you have to remember, yes, he works for Biden, but he also worked for Trump. So I would give Biden credit for holding on to a conservative Republican and making him a part of his administration.
Interesting. Okay. And so you think he'll be around after the next election?
Well, they all serve 6-year terms.
Oh.
So that's on purpose to overlap a presidential cycle. So I don't know.
Yeah. All right. So we have sort of the economy locked down. You and I, we've taken care of all these issues today. What about people who are about to retire, Mike? How are you recommending people like that go forward? Is anything, would you give any different advice in 2024 than you did in 2023?
I don't know if I would give any different advice from one year over the next, other than, to your point about the real estate market. If you are retiring and selling your home, maybe you want to buy another home, maybe you wait a little longer and see what happens with interest rates on the buy side. If you need to sell, you need to sell. But it always is the same old story, Scott. Stay in your lane, stay asset allocated, and make sure that your investments match your income needs. So to me, that's the most important thing any new and current retiree needs to do. It gets back to inflation. Inflation is the beach erosion of a retirement plan. So you need to make sure that your investments are keeping up with inflation and keeping up with your income needs. Because that, Scott, is what could sneak up on you before you know it.
What about, real quick, we're almost out of time, and I want to plug your company, but quickly, what about the rate where now people can save money? So like a CD or something like that used to be nothing. It used to be like 0.5% or 1%. What are those rates now?
So that's the silver lining with interest rates not going down, right? So you could still go into a CD, a U.S. Treasury, a money market that we use in our firm. It's yielding over 5%. So yes, the counter argument about interest rates being higher is that savers and seniors and CD buyers and annuity buyers are being handsomely rewarded.
Great. Okay. Now, Mike, if people want to make some of these maneuvers and change some things around and do a better job in their retirement plan, they can reach out to you. Give us the website for your company and phone number, email address, whatever you got.
So it's Lebenthal.com, Lebenthal, Lebenthal.com. The office number is 516-349-5555. That's the main number. And I can be reached personally at M, my first initial and last name, M Hartzman, Hartzman, at Lebenthal.com.
Yeah, I had a woman stop me on the street and she goes, hey, I like that finance guy you have on your show. It's Lebenthal, right? I said, yeah. She says, I can't reach him. I said, what do you mean? She says, well, it's Laben. No, it's not Lab. It's Leb.
Yes,
Leb. So for a month, she's trying to find you with Lebenthal spelled LA. All right. Anyway, you've been listening to Radio Jobline with Scott Possessor and one of my favorite guests, Michael Hartzman. Fabulous job today, Michael. Thanks so much for being here with us.
Thank you.
Shout out to your wife with her foot.
Thank you.
And hope Dad is doing well. If you'd like to be a guest on Radio Jobline, you can write to me, ScottP118. at gmail.com. Happy to have you or your idea on the radio show, and connect with me on LinkedIn because we post all the radio job lines after they broadcast here on my LinkedIn profile. So it's Possessor, P-A-S-S-E-S-E-R. Have a great week. Happy hunting.
See the sand and stuff. May the four winds blow you safely home.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.